On the morning of August 5, 2024, something unusual happened in global markets. It did not begin with an explosion or a speech or a war. It began quietly with a number on a currency screen in Tokyo. In a single trading session, Japan's main stock index fell more than 12%. That kind of move is rare in any market. It erased months of gains in a single day. Within hours, the shock reached Europe and then the United States. Stock futures dropped before most Americans woke up. Large technology companies lost hundreds of billions in market value before lunch. At the same time, something stranger happened. Gold fell, oil fell, cryptocurrencies fell sharply. Assets that usually move in opposite directions all sank together. That pattern usually appears only when something inside the system breaks. Most headlines blamed fear. Some blamed artificial intelligence stocks, others blamed weak economic data. But those explanations never matched the timing. They never explained why markets across the world moved at once. The real cause was not emotional. It was mechanical. For more than 30 years, the global financial system relied on one quiet assumption: that money in Japan would always be cheap. Japanese interest rates stayed near zero for decades. That decision shaped markets everywhere. It helped inflate stock prices, it helped suppress bond yields. It helped reward risk. It also created a fragile structure that few people noticed. In late July 2024, the Bank of Japan made a small change. They raised interest rates by a fraction of a percent. To most people, it sounded insignificant. But to the financial system, it was a shock. Trillions of dollars were built on the idea that this would never happen. Loans, derivatives, currency trades, all tied to the same quiet source. When that source shifted even slightly, the pressure moved instantly. Within hours, forced selling began. Not because investors lost confidence, but because they needed cash. This is how financial crises often start, not with panic, but with plumbing. A decision in one country begins to drain liquidity somewhere else. The damage appears far away from the source. In this case, the pressure did not stay in Japan. It moved toward US bonds. It moved toward American stocks. It moved toward the heart of the global system. What makes this moment different is scale. The size of these positions is larger than in past crises. The connections are tighter. The margin for error is thinner. Most people believe the danger passed once markets bounced. History suggests otherwise. The early move is rarely the end. It is usually the warning. This story is not about a crash. It is about a shift away from free money, a shift away from stability, a shift that forces old debts to be paid in a new world. And it raises a quiet question worth asking now. What happens to the US economy when the country that funded its excess decides to stop? The real beginning of this story does not start in 2024. It starts more than 3 decades earlier. In the late 1980s, Japan experienced one of the largest asset bubbles in modern history. Land in Tokyo sold for prices that defied logic. Stocks climbed far beyond corporate earnings. When the bubble burst in 1990, the damage was severe. Banks were left with bad loans. Households lost wealth. Confidence collapsed. Japan entered a period that later became known as the Lost Decades. Economic growth slowed. Prices stopped rising. Wages stagnated. To fight this, Japan's central bank took an extreme path. The Bank of Japan pushed interest rates toward zero. By the late 1990s, borrowing money in Japan cost almost nothing. This policy was meant to save the domestic economy. But it had global consequences. Money began to flow outward. Investors realized they could borrow yen cheaply and invest elsewhere. At first, this activity was small. Mostly banks and currency desks noticed it. Over time, it became routine. Hedge funds adopted it. Large asset managers adopted it. By the early 2000s, the practice had a name. It was called the yen carry trade. The idea was simple. Borrow in Japan. Invest in countries with higher returns. For years, the strategy worked quietly. Losses were rare, profits were steady. A former Japanese banker later described it as free oxygen. You did not notice it until it was gone. The Bank of Japan reinforced the system again and again. They cut rates further. They purchased government bonds. At times, they even charged banks for holding cash. Each decision sent the same message. Cheap money in Japan was permanent. As global markets grew more complex, the trade expanded. Derivatives were added. Leverage increased. By the 2010s, this structure supported more than stocks. It supported bond markets, real estate, private equity. Few people outside finance noticed. There was no headline. There was no warning sign. But the system depended on one condition. The yen had to stay weak. As long as that held, the trade survived. As long as it survived, asset prices kept rising. This arrangement shaped an entire generation of investors. It rewarded borrowing, it punished saving. It also tied global stability to one central bank. If Japan ever changed course, the effects would not stay local. They would travel through currencies first, then through markets. At the time, most people dismissed that risk. The Bank of Japan had promised stability for decades. But history has a pattern. When policies last too long, they stop working the way they were intended. That quiet vulnerability was already in place long before 2024. And the question now becomes simple. What happens when a system built to avoid collapse begins to create one instead? The first visible shift did not arrive with panic. It arrived with pressure. By 2022, inflation returned to the global economy. Energy prices surged. Food costs rose. Most countries responded by raising interest rates. The United States moved quickly. Europe followed. Japan did not. The Bank of Japan kept rates near zero. This created a growing gap. U.S. interest rates climbed above 5%. Japanese rates remained close to nothing. That difference mattered. It made borrowing yen even more attractive. Capital flowed outward faster. As more money left Japan, the yen weakened. By mid-2023, the currency fell to levels not seen in decades. $1 bought more than 150 yen. Inside Japan, the effects became visible. Imports grew more expensive. Fuel costs rose. Food prices increased. For households, this was new. Japan had lived with stable prices for years. Now grocery bills changed month to month. Wages did not keep up. Public frustration grew quietly. Inside financial institutions, the concern was different. A weaker yen increased currency risk. Hedging costs climbed. Some banks reportedly began to shorten positions. Others absorbed losses, hoping the trend would reverse. Government officials tried verbal warnings. They spoke about stability. They hinted at intervention. The market did not listen. By early 2024, the yen hovered near historic lows. The cost of defending it was rising. The political pressure was rising. Insiders later said the choice became unavoidable. Protect global markets or protect domestic stability. In July 2024, the tone changed. Bank of Japan officials signaled adjustment. Language shifted away from permanence. When the rate move finally came, it was small. Only 0.25%. But markets understood the signal immediately. The era of certainty was ending. Currency desks reacted first. The yen strengthened. Then leverage reacted. Positions built over years faced stress in days. What looked like a technical adjustment became a turning point. And it raises an important question. When a long-standing policy begins to unwind, who really controls the outcome? The part most people miss is how the machine actually works. The yen carry trade is not a theory. It is a plumbing system. At its core, the process is simple. Money is borrowed in Japan at very low interest rates. That money is then converted into dollars. Those dollars are invested in higher-yielding assets, U.S. government bonds, corporate debt, stocks, private funds. As long as Japanese rates stay low, the cost of borrowing stays low. As long as the yen stays weak, the debt shrinks in dollar terms. This combination created years of steady profit. But there is a hidden layer that matters more than returns. Currency risk. When a fund borrows yen, it owes yen, not dollars. If the yen strengthens, the debt becomes more expensive instantly. To manage this risk, large investors use hedges. They buy protection through swaps and derivatives. Those hedges are not free. Their cost depends on interest rate differences between countries. As U.S. rates rose and Japanese rates stayed near zero, the cost of hedging exploded. For some investors, the hedge cost erased all profit. For others, it created losses even before prices moved. A Japanese banker later described it as paying rent just to stay in the building. Now imagine this structure at scale. Trillions of dollars borrowed. Thousands of institutions involved. When the Bank of Japan raised rates even slightly, two things happened at once. The yen strengthened. Hedging costs rose further. Positions that looked stable on paper suddenly broke their limits. Banks demanded more collateral. Funds were asked to post cash. This is where forced selling begins. Assets are not sold because they are bad. They are sold because they are liquid, technology stocks, treasury bonds, cryptocurrencies. Anything that can be sold quickly becomes a source of cash. This explains why different markets fell together. It was not fear. It was math. An insider at a major fund later said the screen did not show panic. It showed margin calls. Once this process starts, it feeds on itself. Selling strengthens the yen further. A stronger yen triggers more selling. This loop does not need headlines to operate. It only needs pressure. And it leads to a quiet question worth asking now. If a system depends on cheap money staying cheap forever, what happens the moment that promise breaks? The consequence arrives slowly and almost invisibly. As the yen strengthened, the cost of protecting dollar investments kept rising. This detail rarely makes headlines. For Japanese banks and pension funds, it became a daily problem. They held large amounts of used bonds. Those bonds paid interest, but hedging the currency risk consumed that income. By early 2024, some institutions were losing money simply by holding safe assets. Internal reports later showed growing concern. Balance sheets were under pressure. Capital buffers thinned. One large Japanese bank disclosed billions in projected losses tied to foreign bond holdings, not from defaults, not from bad credit, from currency protection costs. For conservative institutions, this was unsettling. They are not built for volatility. A retired Japanese saver later described the situation simply. The money was supposed to be safe. To stop the bleeding, banks had limited options. They could raise capital, they could absorb losses, or they could sell assets. Selling became the least damaging choice. Quietly at first, Japanese institutions began reducing foreign bond exposure, U.S. Treasury holdings, European sovereign debt. These sales did not cause immediate chaos, but they removed liquidity from markets that depend on steady buyers. Bond prices weakened, yields drifted higher. Higher yields created new stress elsewhere. Mortgage rates rose. Refinancing slowed. None of this felt dramatic. It felt technical. But this is how systemic problems grow. Through routine decisions repeated across many balance sheets. Insiders reportedly warned that this was only the first wave. Many positions remained open. Many hedges were still rolling. The system was adjusting to a new cost of money. And the adjustment was not finished. This leads to an uncomfortable question. If safe assets no longer feel safe, where does the pressure move next? Once selling began, it did not stay contained. Each reduction in exposure tightened conditions elsewhere. As Japanese institutions sold foreign bonds, yields moved higher. Higher yields lowered the value of bonds already held by U.S. banks. Those unrealized losses had been manageable when markets were calm. As prices fell, they became harder to ignore. At the same time, hedge funds faced a different strain. Their funding costs rose. Their leverage limits tightened. To stay within risk models, positions were trimmed. Not strategically, automatically. This created a second wave of selling. Capital flowed back toward Japan. Repatriation strengthened the yen further. A stronger yen fed back into the carry trade unwind. The loop tightened. Across markets, correlations increased. Assets that once moved independently began moving together. Credit spreads widened. Liquidity thinned. Inside large institutions, risk committees met more often. Exposure reports were reviewed daily. A portfolio manager later recalled watching cash balances disappear faster than expected. Regulators noticed the shift. Central banks began monitoring funding markets more closely. Public statements remained calm. Behind-the-scenes contingency planning increased. By mid-August, stress indicators reached levels last seen during prior crises. Not from defaults. From funding strain, retail investors felt it differently. Account balances swung sharply. Volatility returned after years of quiet markets. The escalation did not rely on panic selling. It relied on structure. Every rule-based system responded the same way: reduce risk, raise cash. This is how modern markets behave under pressure. The danger is not speed, it is momentum. Once liquidity starts moving home, it rarely stops all at once. And that sets the stage for the moment everyone remembers. The breaking point arrived not with a crash but with a realization. On a single August morning, the yen moved sharply higher. The change looked modest on a chart. Inside portfolios, it was devastating. Positions that had survived years of calm crossed their limits at once. Margin calls went out across time zones. Some funds met them, others did not. Banks demanded collateral in cash. Not promises. Not assets. Selling accelerated. What made this moment different was timing. Markets were closed in some regions and open in others. Assets that traded around the clock absorbed the pressure first. Prices fell fast. By the time traditional markets opened, the damage was already visible. Trading desks described the morning as mechanical. Orders hit without discretion. There was no search for value. Only the need to reduce exposure. Behind the scenes, central banks monitored funding conditions closely. Swap lines were discussed. Liquidity tools were reviewed. No emergency announcements were made. That silence mattered. It signaled that the adjustment was expected to continue. An executive at a large asset manager later said the stress did not come from fear of recession. It came from the realization that the old funding source was no longer reliable. This was the moment the carry trade stopped being a strategy and became a risk. Once that shift occurs, models change. Assumptions break. The system did not collapse. But it cracked. And cracks have a habit of widening under pressure. Which leads to the question few want to answer. If this was only the first true test, what happens when the next one arrives? When the pieces are placed together, a clear pattern appears. This was not an isolated shock. It was the unwinding of a long cycle. History offers close parallels. In 1998, a highly leveraged hedge fund collapsed after a sudden currency move. Cheap funding reversed. Positions built over years failed in days. The same structure appeared during the global financial crisis. Short-term funding supported long-term assets. When trust faded, liquidity vanished. The yen carry trade followed this pattern quietly for decades. Stability encouraged leverage. Leverage encouraged size. Each calm year made the system more fragile. The trigger was not the size of the rate hike. It was the change in direction. Once markets believe cheap funding may not return, assumptions shift everywhere. Currency strength becomes a threat, not a detail. Capital begins to retreat toward home. Risk premiums rise. This pattern has repeated across countries and decades. Latin America in the 1980s, Asia in the late 1990s, Europe after the debt crisis. The details differ. The structure remains. Borrow short. Invest long. Rely on stability. When stability fades, the unwind begins. What makes this moment unique is scale. The yen has funded global growth for 30 years. Its reversal touches everything. This is not a forecast, it is a recognition. The system is shifting from abundance to constraint. And that raises a thoughtful question. If the world adjusts to scarce capital instead of cheap capital, which assumptions will fail next? The long-term effects of this shift are already visible. Capital is becoming more selective. Risk is being priced again. Governments that relied on steady foreign demand for their debt are adjusting. Borrowing costs are drifting higher. For the United States, this matters. Foreign buyers have long played a quiet role in funding deficits. As Japanese institutions reduce exposure, the burden shifts inward. Domestic buyers must absorb more supply. That change tightens financial conditions even without policy action. Corporations feel it through higher financing costs. Households feel it through higher loan rates. Markets that thrived on leverage face a different environment. Growth becomes slower. Volatility becomes normal. In asset markets, the premium moves toward liquidity. Cash regains value. This does not mean collapse. It means adjustment. History suggests this process takes years, not weeks. During similar transitions, wealth shifts quietly. From borrowers to savers, from speculation to durability. Central banks face difficult trade-offs. Protect currencies or protect markets. There is no painless choice. Past episodes show that policy responses often arrive late, only after stress becomes visible. The echoes of earlier decisions remain. Low rates encouraged borrowing. Borrowing created exposure. Now that exposure must be carried in a new world. This transition shapes investment behavior more than any headline. And it leads to a reflective question. In a system adjusting to restraint, who is prepared to operate without easy money? The final frame of this story is not about blame. It is about understanding. For decades, global markets were built on one quiet assumption. That capital would always be cheap somewhere. Japan played that role longer than anyone expected. Its policies supported growth far beyond its borders. But no financial arrangement lasts forever. When conditions change, old advantages become risks. What once stabilized markets begins to destabilize them. The yen black swan is not a single event. It is a signal. A signal that the era of effortless borrowing is ending. History offers a useful comparison. After the inflationary 1970s, markets learned to live with higher rates. Behavior changed. Expectations adjusted. This moment carries a similar lesson. Returns will matter more than stories. Balance sheets will matter more than momentum. Resilience replaces speed. For the United States, the challenge is subtle but serious. Funding costs rise gradually. Choices narrow quietly. None of this feels dramatic day to day. Yet it reshapes the future. The question now is not whether markets recover. They often do. The real question is whether investors recognize the shift beneath them. Are decisions being made for the world that was, or for the world that is forming now?